Financial advisors have called on consumers to invest in asset classes that are likely to offer higher returns and can beat inflation. They've reiterated that you do not need to be a sophisticated investor to have a good investment portfolio, and that you need to differentiate between saving and investing.
South Africa's household savings rate is currently 18% of gross domestic product. And with July being savings month, consumers are once again urged to invest more and spend less.
For those people that are employed, we do seem also to be a nation of consumers. We like to consume things. We like to have cars and houses, and that's probably our failing at the moment.
It is suggested that you should have a clear plan of what you want to achieve when you are investing. If you want to save for emergencies, then you should consider putting your money where it will be easily accessible, like a bank account. And if you want to invest for the long term, it should be invested in portfolios linked to the stock market.
It's wise to have a 30-day call account, to have money that's going to be not in a volatile space, not invested in the market. Once you've ticked that box, you then move along into longer term investing, and definitely if you're not in the JSE, if you're not in the market, you're missing potential massive growth.
There's a variety of investment options to choose from, ranging from exchange-traded funds, Cetrix Top 40 and unit trusts. Both ETFs and unit trusts are collective investment schemes. With ETFs, you will pay brokerage fees as you are likely to utilize the services of a stockbroker, whereas unit trusts are actively managed by a fund manager. ETFs are less volatile than some unit trusts. ETFs are likely to have low costs, whereas unit trust costs might be slightly higher. ETFs are priced immediately, and unit trusts are priced on a daily basis.
The difference with ETFs is you actually own the underlying shares or securities on that exchange. So you actually buy and sell the shares as well through a broker.
If you want good returns, you should diversify your investment and have some exposure to the equity market. These are aggressive investments with possible good growth, but you must be willing to invest for the long term and bear in mind that equities are volatile in nature.
If you put money just purely into an interest-bearing account, you have to consider the effects of inflation. That's one of the enemies of saving and us just living generally. It means the value of your money declines over time. So if we look at our inflation rate at the moment, around 4.5%, that means typically that your money today is worth 4.5% less, or it can buy 4.5% less than it could last year.
Investing is a long-term decision, and the younger you start saving, the better, because you will benefit from compound interest, and always ensure that you invest in growth assets that can beat inflation and are linked to the stock market, instead of just putting your money in a bank account. Tax-free savings gives you an opportunity to save without having to incur capital gains tax, but you are only allowed to invest up to 33,000 rand per year and a maximum of 500,000 rand in your lifetime.
I'm a big fan of tax-free savings. They have their place in a portfolio. So once a client has got that emergency savings and they've got that liquid unit trust or discretionary money ticked, then they look at tax-free savings. Tax-free savings, of course, they benefit from no capital gains, dividend interest tax, etc. The downside or upside is you are limited to 33,000 per annum that you can put in there, and also capped at 500,000 per lifetime. They go very nicely hand in hand with retirement annuity investments or longer term investment.
I'd like to hear your views on this topic. My email address is mulifint@sabc.co.za. My Twitter handle is @mulifinaledi.